Are you ready to take your basic knowledge of the options market and kick things into gear? Then this video is for you. What we're going to be doing is I'm going to be breaking down the transitionary concepts that you need to know in order to position yourself as an active day trader and swing trader in the options market. My name is Kozak, founder of NSTA, and for the world's best trading education and strategies, make sure you hit that subscribe button and be sure to turn that notification bell on so that each time we put out content like this, you can get results. Last but not least, make sure you give me a thumbs up so that I know you're engaging in the content. Now, the thing about the options market is it's normally considered complex, and rightfully so, that's true, but it doesn't have to be difficult if you're shown the right path. And that's exactly what our traders rely on in our trading rooms, especially today when we were calling swing trades at the right time, building positions, and deciding whether we wanted to trade stocks or options, and that's the key to our success. And we're going to show you exactly how we do that so that moving forward you can trade it with confidence. Now what we're going to do is we're going to talk about these 5 concepts, okay? You need to learn about options expiration and why it basically affects time decay and the concepts around the options chain so that you know exactly how to leverage the Greeks and how to leverage the options market properly. Then what we're going to do is we're going to go into the different styles and types of option contracts available to you moving forward. We're going to break down the quotes of an options contract and how to look at the options chain so that you know what you're looking at moving forward. Then we're going to transition into in the money, at the money, and out of the money trading jargon so that you know when you're building your positions where you stand with your break-even analysis and how to position yourself for profit and loss graphs. Then we're going to break down value and how you determine value, and then we're going to end by giving you a summary which is going to extend on a checklist for you, which is going to basically break down options positions so that you have a step-by-step guide moving forward. Now, the reason I feel that this is really important concepts to know is that unlike other asset classes, options can be a very powerful asset used carefully, but when done incorrectly, it can be catastrophic. And we're going to make sure that you never fall short moving forward. Let's jump onto the charts. We're going to get right into the details and make sure you're taking notes because this concept is very powerful. See you on the screens. Welcome back, traders. In this video, we're going to be breaking down Options Explained Part 2, where we start discussing option mechanics. Now, in the first video was a great primer on dynamics of options trading. We talked about a foundation. We gave some breakdowns, the difference between being a buyer and seller of options, and also the difference between calls and puts. We talked about some terminology and some main outcomes on some of the different plays in which we want to play the market for a directional trading opportunity. But now what we're going to do is we're going to break down the actual option quotes, and we're going to start talking about some terminology that I think is really important moving forward. And as always, if you have any questions or you need assistance in the course, we're always here for you. And one thing I forgot to mention in the prior video is after you're done the options intro 101 video, you can come back and you can actually go into the education courses and the strategy classes and into our trading rooms, because all of the stuff that we talk about with the indicators and the chart patterns and the price patterns and then all the strategies that we trade, all of those are completely relevant to the options lesson, because options are just an alternative way to participate in the trade. And instead of, say, trading the option on this, or instead of trading the stock, you could actually trade the option, right? So it's just about making sure you understand how we merge those all together. So let's kind of talk a little bit about options expiration. So an option contract has a lifespan, and once the expiration takes place, the contract has no right or obligation after that. So an option contracts expire on the Saturday following the 3rd Friday of each month. So this is always something to understand, except for weekly options. Weekly options expire weekly, and we'll talk about those in another example. But the main point is most option contracts expire on the Saturday following the 3rd Friday of every trading month, okay? And expiration date is the last day on which an option can be exercised or assigned. So that is essentially when you can exercise your option or you can be assigned the option depending if you're a buyer or a seller. And then the expiration time is the time of day on expiration date that all notices to exercise must be received on, right? So The main thing here too is a lot of you watching this video won't be exercising your options. In fact, it's something that we don't spend a lot of time on in this course, is holding contracts into expiration, that type of stuff. It's not really part of our core strategies. So it's good to know this information and understand it, but it's not something that you have to be concerned about holding your contracts through to the expiration dates, right? We want to be getting out of the positions before this happens. So the expiration cycle is the pattern the exchanges list the new option series on. So options will be assigned either to the January, February, March cycle, right? And these are just examples. Leaps are excluded from this, and each cycle allows the ability to trade the 2 nearest expiration months and 3 series separated by 3-month intervals. And so just kind of give you an example of that, like there's different cycles in which the option contracts are made, and you'll see them in the options chain. We're going to spend time going through the option chain so you understand that, and it's just about making sure that you grasp that and you have a fair understanding of just the terminology around expiration. Okay, so there's 2 types of options. There's an American style option. This can be exercised at any time on or before the expiration date. And then there's a European style, and they can only be exercised on the expiration date. And these are kind of more meant for sellers of options, okay? So it's really simple. There's an American style option or a European style option, okay? Now, let's talk about the different types of options. So when considering options and the fact that they are a derivative of the stock, we can participate in trading them in numerous ways. In fact, options, when we say, I should have said derivative of the underlying asset, because technically, even though I've been referring to options on stocks, you can trade options on stocks, ETFs. You could actually trade them on commodities, futures contracts, indexes, weekly stocks, right? Like the weekly option contracts. So the main thing here is, for the sake of this course, we're only going to be mainly looking at covering options on stocks and ETFs, which also includes the weeklies. But you can actually trade options on futures and commodities. It's just not something that we focus on primarily here because of the nature of our school's focus and the intention of our classrooms, okay? So it's good just to know that there's a lot of ways in which you can leverage options, okay? So this is a very important slide. Very, very important slide. So we're going to go through it together, and then we're going to go to an option chain and look at this, okay? So an option quote will look like this: 10 ABC January 50 put at 550, okay? You say, well, what does that mean? Well, no different than, let's say you're looking at a stock ticker. It's how you identify the option that's relative to the stock, okay? So 10 the first number would be the number of options contracts, okay? Right there. 10 is the number of options contracts. ABC is the actual asset. So 10, let's say you want to do 10 Google. So it'd be 10 Google ticker. Then the January is the expiration month. If not current year, the year will be stated. Okay, if it's not the current year, if it's, let's say you're doing this in January and you buy an option contract for the next, let's say it's December, and you're exercising the option in January, then they'll have a year here. Okay, and let's go to the strike price. So the strike price is 50. So this is kind of like your locked in price. So, you know, it's almost like when you buy real estate pre-construction, you have a locked in price on your mortgage. And then when the price goes up, you have the right to get your mortgage at the locked in price. Same thing with options contract. If I were to buy a call option here for $50, I have the right, but not the obligation, to buy the shares. Okay, even if it goes to 75, I've locked in the price of my options, those shares, at $50. That's the strike price. Now put, remember we talk about the difference between calls or puts, it's the type of option. So this would tell me that I'm bearish. If this is a put option, and I'm a buyer of this option contract, that would be bearish. If I was a seller of this option contract, that would mean I was bullish, right? Because remember, as a buyer of a put option, I want the stock price to go down. As a seller of a put option, okay, I want the stock price to go up. I want to be selling puts down here. And so it's just a little bit of a backwards thinking process, but we covered that in the prior video. Now at 550, is the price / premium for one contract. So since I've got 10 contracts, that's 550 times 10 contracts times 100 shares, because you're always multiplying by 100 shares. So one contract equals, okay, 100 shares. 10 contracts equals times 10 times 100 shares. You're always going in 100 share increments. Always, 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 always. So one contract equals 100 shares. So you're always multiplying by 100 shares. So if this was 1, ABC January 50 put at 550, this would be 1. But you'd still have the 100 shares in there. Always multiply each contract by 100 shares. That's the way the option market works. That's the leverage. That's the factor of the leverage that we're talking about. Okay. So when we go into an options contract, or when we go into an options chain, every platform designs their option chain a little differently. Okay. And we will cover all the components of this chain later in the course. But for the most part, I want to go through an example. So let's just say we're looking at, I'm going to grab this. Use this as an example, okay? So let's just kind of grab this. I'm going to use TradeStation for this example. Just, it doesn't matter the platform really, because many of you watching this are going to have your own options platform. You might be using TradeStation. You might be using Thinkorswim. Maybe you're using TC2000. Maybe you're using Questrade. Whatever the case may be, right? You're going to be using the option platform that you're using. But the main focus is the education around what I'm teaching you. So I'm going to grab the options window here. This is the option chain for TradeStation. And you're going to notice here that right here. So if I wanted to, let's take a look at this. Let's bring this over here. Just bring this. I'm going to make this a little bit bigger so you can see this. And today's date is the 11/50 and November 15th. Okay. So if you look, November 15th, if I go, these are next, the weeklies are here, and then you've got the regular option contracts. You can see the weeklies here. Those are weekly, and then we've got quarterly options, okay? So if I go here, these are the November 20th, 18th of November contracts, and these are 2-day options. These expire in 2 days. So, you know, like this is probably going to be a little bit too close. So these expire on the 20th. You say the 20 November 2020, we're in the 20 year. So these expire on the 20th. So if we go here and we look at the date, these are expiring, you know, the 23rd, the 25th. So if I look at, if I wanted to participate in an options contract that, you know, was expiring, remember, you know, on the 20th, then I would use the 21. I would use the 23rd, because I would want to basically make sure that I have the potential. Let me grab this here. I'll just show you the date. That if I wanted to get out of this contract by Friday, then I need to make sure that I'm trading a contract that's expiring, say, on the next week on the 23rd. So I would be looking at these ones right here. I'd be looking at this option chain. Okay. Now, right now you're seeing a list of one, and I want you to read this diagonally here so you understand this. And we're going to go through the options chain together. 1, 2, 3, 4, 5, 6, 7, 8. There's 8 option contracts listed here. And this says strike 8, which means I will see 8 on that environment. So if I wanted to list 10 strike prices, you know, I don't think there's 10 here. If I wanted to list 30 strike prices, there they are. I wanted to list a whole bunch of option contracts, right? There they are. So this is all the option contracts are available. I could choose how many strikes I want. It's really up to you how you see this. That way, whenever you list, you've got a lot more to choose from. But the point of the matter is I want to kind of go through a quote with you, right? So let's just kind of, let's say I wanted to go 10 contracts. I could go 10 contracts, and this is the spiders. So if I'm looking at the market that I'm looking at here, it's the spiders. So this would read 10 SPY. Okay, and this would be November, okay, November 20, and then I would decide, okay, which contract I wanted. So I would need to decide, am I getting in with a call or a put? So let's say we're doing a call option, call at, so we need the strike price. So November 20, we need the strike price, that's 50. So I would put the strike price in here at 351. So November, this should be November. Let's say I wanted to take this one here at 351 right here, this or the strike price here. Either way, the strike price is the price in which we're locking in this option contract. So what we'll do is we'll go and we'll pick, let's say I wanted to have this option contract, okay? Then I would put it 352.50. So November at 352.50 strike price, call at, okay? And this is where we get to look at the premium. What is the price? So the asking price right now, or the bidding price, these are the bid price and the asking. So if I'm going to buy, bid and ask, you can see here that this is the asking price for this contract at 352.50. 352.50, where are we here? Right there. So the asking price is 756 and the bidding price is 747. So you can see there's a spread there. Now we've got rules around the spread. We've got rules around the spread, and normally we could take the midpoint of the spread, try to negotiate the spread. So you don't always have to buy at the ask or at the bid. Okay, you don't always have to be buying at the ask or at the bid. You could say, I'm going to put an order in for this option contract, and that's 7. That's 9, so split the difference of 5. So let's say 52. We wanted to buy this at 52, so we'd put at 7.52. That's the option contract for here. That's and that's looking at this option contract right here. It's no different. It's just looking at it like that. Right there it is. Now everything on the left is calls. Everything on the right is puts. So if I'm bullish, I'm looking over here. If I'm a buyer and I'm bullish, that's how I would look at that call. That's how that quote would look. Okay, so hopefully that's a good example of breaking down an options quote for you. Another example would be to use, let's say, a different platform. You could look at this. If I'm looking at the spiders, it's just the same thing. You're just looking at it from a different perspective. I can expand this out. I can choose the strike prices. 9. I could go to all strikes. And there they are, tons of them, right? And normally 9 strikes is a pretty solid number. You can let the information fill out here, and the calls are on the left, the puts are on the right. You can set that up however you choose. You've got the strike price here, right? And you can see this here, all of these different environments. That's the last price of the option. Okay, the bid and the ask is here. You don't have a bid and the ask because it's not trading right now, but it's the same thing. You have the strike price, you've got the option date. So if we wanted to look here, those I don't think are trading anymore. That's why there's nothing there. November 20th. Let's go to the November 23rd contract here. So that's the exact same. We were just looking at the exact same option chain, right? So it's just a different platform, different intuitive look. If we look at if we look at the same here, if we got the spiders, we go to the same option contract. You're looking here at the 23rd November. There's the strike price, and if we're looking at 352, right in here, you can see these. You can see these are all there, and there's just, there's the last price on these options, and there's the bidding price and the asking price, and it's really just a good way to learn how to read your platform's option chain, and we're going to spend some time on that, right? We're going to spend some time on that and how that works and your preference around this, but realistically, it's quite simple once you get quite used to the terminology. It's just really memorizing the actual quote, so that when you're getting ready to take a trade, you're not confused on what you're looking for, right? And that's really where just studying the option chain and getting familiar with what it reads, right? And so we're going to go through that in more detail as we progress through the course, because there's a lot more things you're going to need to learn on the option chain that are quite efficient. Okay, so let's talk about some terminology. In the money, you're going to hear option traders talk about in the money. An option that is considered to be in the money is if the money can be obtained by exercising the option, liquidating the position. So when your option is in the money, it means, well, there's two types of in the money. When you're a call option, when the stock price is greater than the strike price. So this is really simple. If you're buying in, if you're in the money, if you're an in the money option, you're a profitable option, potentially, depending on if the other Greeks are not going against you. We'll get into that after. But let's say, oh, wrong color. Let's say if you're here, okay, an in the money option. Let's say you had an in the money, your strike price is 48, right? And the stock traded up to 50 bucks. You're in the money by $2. Put, you're here, trades down, boom, boom, boom. Strike price is 50. Stock price trades to 48. You're in the money $2 because you're looking for puts. Your call option and your put option, right? So it's just really simple to understand. The in the money means, you know, the spread in which you're profitable on the price differential between the strike and the current price. Okay. An option that is at the money, technically an option is in the money, but the closest strike price to the price is considered at the money. So technically the option is always going to be in the money, but the closest strike price is considered at the money. Okay, so calls and puts when the stock price is equal to the strike price. Okay, so if the stock price is 50.25 and the strike price is 50, you're at the money, right? It's pretty much right there. Okay, so we'll talk about out of the money. An option is out of the money if no value is obtained by exercising the option and liquidating the position. Okay, so technically, it hasn't got, like, let's say you buy an option contract. Let's say you buy a call option, right? Let's say your stock price is, let's say you buy the strike price at 50. Okay, let's say you think the price is going to 75 bucks. Okay, that's a good example like this. And you buy the 50 calls, but it's currently trading at 48 bucks. Okay, so right now you buy this option contract. You lock in 50 bucks. The stock is trading at 48 because you have a really big bullish expectation on this stock. So what you're doing is you're saying it's out of the money. So what that means is it needs to move $2 to become at the money, or move slightly bigger to become in the money, right? So out of the money means you have not yet reached your strike price yet. And the reverse is true for puts, right? If I'm at 52, let's say you know your strike price is 50. Okay, you're hoping that it's going to 25, and you get in here at 52. So current price is here. Your option is at 50. You're hoping it goes to 25. It needs to move $2 because it's out of the money still, and then it needs to drop for you to be in the money. Okay, very clean example, very simple to understand that. It's just terminology. Your strike price, it's always comparing your strike price versus your current price of the stock. So remember how that works for calls and puts. Remember, calls, you're always looking to go up, and puts, you're always looking to go down. So you're always looking at the differential between, you know, the current price versus the strike price. Now let's talk a little bit about value. It's a very important conversation with option trading is discussing value. So the term intrinsic value is the amount in dollars that can be realized if the option is exercised at the strike price, then liquidated at market value. Okay, an out of the money option has no intrinsic value. So calls, you have intrinsic value when the amount above the strike price is true. For puts, it's below. So when you're in the money, you have intrinsic value, essentially, because for calls, if you're in the money, you have intrinsic value because the amount of the strike price, it's when any amount above the strike price. So I'll give you an example. I like visuals because its terminology is quite tricky in options, so I really think visuals helps. So let's say $50 is your strike price. It's trading at 52. Okay, you're in the money by $2, but that's your intrinsic value as well. You have intrinsic value there because you can execute and close the position. It says the amount in dollars that can be realized if the option is exercised at the strike price, then liquidate at market value. Okay. So, and for puts, it's the same thing. You got 50, you're going to 48 in the money equals $2, and then that's your intrinsic value as well. Okay. So just some terms to be aware of. So I'll give you an example. This is the exact same thing. You're in the money by $2. Your intrinsic value is $2. Example, your stock price is $25. Your strike price is $27. There is no intrinsic value because it can never be zero. It can never be greater than negative value. Okay. For puts, same thing. Stock price is 50. Strike price is 48. Out of the money by 2. There's no intrinsic value. Stock price 25, strike price 27. You're in the money by $2. Your intrinsic value is $2. Very simple, very easy to understand that. Okay. So let's talk about determining value. So determining value is described by many different ways. Time value is one of them. So the value that is over and above the intrinsic value that buyers will pay in order to have the right to buy or sell. So you got to remember, an option contract expires. So time has value as well, right? Because certain things have to happen in a certain period of time in order for that contract to be valued something of nature to a buyer or a seller. So you're not just expecting the stock to do something or the asset at that matter, but you're expecting it to do something within a certain period of time. So that actually brings in an element of granularity that's what makes option trading so so appealing, but yet so extreme in many ways. Okay, so if an option has no intrinsic value and is out of the money, then the option premium that is paid for the option contract solely based on time value. Because if you're out of the money options, there's no intrinsic value. So there's no extra reason to have an extra premium. So you're paying for an out of the money option, and the option has not yet become something of an intrinsic valued nature, right? And then time value assumes the likelihood that the option contract will have a value at expiration. So what you're doing is you're just paying, your option contract is based on time value alone. And this is interesting because if you're buying out of the money options, then you're assuming that your analysis is going to be correct in a certain period of time. And the longer the time to expiration, the greater the time value, because it gives you more time for what you're expecting the market to do to play out, which is really interesting, right? Like if I'm expecting, okay, I'll give you an example. If I have a level of support down here and the stock's trading up here, well, if I buy an option contract at $50 strike price, I'm expecting that it might be here. I'm waiting for the stock to drop, fill my option contract, okay, and then rally, and it has to happen in a certain period of time. And if it hasn't happened yet, like if I have no intrinsic value and I'm out of the money, then I'm banking my entire valuation of that option contract on time value alone. And the longer I have a window of time, the longer I have for this stock to do what I need it to do, which is why when you have longer time periods, normally the time value puts a bigger premium on the option. Sometimes, not always. We'll take a look at it. And this is since the price of the underlying has a longer time to fulfill the outlook or to go in the money. Makes more sense, right? You're not putting yourself under more restrictions. So determining value, let's take a look at this. An option premium, so when you look at paying a premium on the option, it's time value plus intrinsic value. Time value plus intrinsic value. So when you look at how you pay a premium on the option, like the price of the option has a premium, okay? And that premium is collected by the seller. So if you're a seller of options, you get paid that premium. And if you're a buyer of options, you pay that premium, okay? And so essentially, if you think about it, it really depends on whether the option is in the money or out of the money to determine if it has intrinsic value. You're always going to have time value associated to it, but the question is whether or not there's intrinsic value that's merged into the option valuation, okay? So stock price is trading at $72. This is a call option example. So I like to draw images. It's super important for this call. If it's a call option, okay, stock price is 72, strike price is 70. So let's put 70 here, strike price. Option price is now at stock price is at 72. Okay, so I've got the strike price, and then I got the stock price. So there's an intrinsic value of $2. Yep, I'm in the money by $2. My time value, okay, my time value is my premium minus my intrinsic value. So that's my premium, $4.50, minus my $2. So that's how I'll know what this option's value of time is. I will take the $4.50. I will subtract my $2 intrinsic value, and I'll be left with $2.50, which means the time value of this option is worth $2.50, and the intrinsic value is worth $2. My premium is worth $4. Okay. For a put option, I'm looking for the stock to drop. Stock price is here at 48. Strike price is 50. Intrinsic value is $2. My time value is my premium. My time window is 325 minus 2 equals 125. Mathematically, that's how you calculate time value and premiums with intrinsic value and time value. So that's how you determine the difference between how an option contract is valued, how the value of an options contract, right? And that's important, right? It's important to understand the valuation of those. And we're going to get into this. We're going to get into this more as we go along the lines, right? We're going to talk a little bit more about that, and we'll go through that here as we progress. Okay. So let's carry on here and talk about the assignment process. So when you're exiting a long position, remember, long you're a buyer. You can either be buying calls or buying puts. You can simply just sell the call or put option to exit or close the position. Winning, let's just write that down. Very important. Very important. When you exit, just close the option contract. It is recommended to never exercise your option. Now, I'm not saying recommended by giving you advice. I'm just suggesting that it's much wiser to consider that option. Simply sell for a profit or a loss to avoid the assignment process. Think about this. Do you really want to get involved in all that extra hoopla that is going on in the option chain and the exercising on the third date and the exercising of the option contract and being responsible for the stock or being obligated with the stock? No thanks, right? The assignment of the option is when the buyer of either a call or a put decides to exercise the right to buy or sell. So this means to exercise the option buyer must notify their broker that they would like to exercise their right. And this is only if you're planning on getting involved with the position, right? 9 times out of 10, this is 95% of all option traders up here. 95% of most speculating option traders, okay? The seller, the writer of the option, is obligated to fulfill their end of the contract to either buy or sell the underlying at the stated price. Now, remember, you could be a seller of an option, no different than if you're a buyer of an option, okay? And you can just close the position. Even if you're a seller of the option, you can still do the same thing. This is 90. So technically, I should have written another bullet in here, and I should have just said that the same thing here is that when you're exiting a seller's position, okay, just because you're obligated to fulfill their end of the contract doesn't mean you need to actually you need to do that. You can actually close out of the position. Just because you're selling the option doesn't mean you actually have to hold that option into expiration. You could just close the option contract, right? But we're going to focus more on buying options, okay? All in the money options will automatically be exercised at expiration. If the option exercises, if you're in the money and the expiration expires, it will be automatically exercised. Okay? So let's kind of bring this into perspective. Call options. The option writer or seller is obligated to sell the underlying at the strike price. The option writer / seller is obligated to sell the underlying at the strike price. The seller will either become short the stock or flat if they previously owned the underlying stock. Let's talk put options. The option writer or seller is obligated to buy the underlying at the strike price. Okay, the seller will either become long the stock or flat if they previously short the underlying. Okay, so let's make sure you think on that for a second. Remember, the seller of options is always taking the opposing side of the buyer. So they are obligated to participate in the actual stock. That's only if they're choosing to hold it into expiration, right? You can exit as a seller, you can exit your position to another buyer, right? Like you can get out. You don't have to hold on to those contracts. It's like the stocks. You don't need to own the stock. If you want to sell, sell. You want to get out of the position, get out of the position, right? That's the difference between a lot of people. They get confused with option contracts and they think that just because there's the terms, they're obligated, they have the rights, this type of stuff, doesn't mean you need to hold on to the contract. You either take a loss, or you take a win, get in and get out. And we'll talk about that. So position review. I want to just kind of simplify this because it's really not that difficult. I've built this course to keep it super simple. So position review. Long, you're either buying calls or puts. Short, you're either selling calls or puts. Bullish, you're long calls or short puts. And bearish, you're long puts and short calls. Okay. So what I want to do here is I just want to stop this for a second because the main goal of this lesson is terminology about in the money, out of the money options. Okay. And there's ways you can set these platforms up. And let's take a look at TC2000. I think there was one. Let's take a see here if there's an in the money. Let me take a look here and see if they have one here. Option in the money, out of the money. So this is just a column you can add. Okay. So this is, you can do this on other platforms too. So I'm going to go and just do this. I'm sure you can add this to many different platforms. I just find their platform to be quite intuitive. Okay, so I'll give you an example. Okay, so if I'm looking at the spiders here, okay, on an option chain, and I'm looking at January, November. So these are SPG. These are SPG options. Okay, so I'm looking at the SPG option, and I'm looking at November 20th. November, 5 days remaining, 33 days remaining, right? So what we're doing here is we can look at these options down here, and I'll just kind of give you an example. This is call options, by the way. These are calls. I'll just show you here. Call options. If I look down here at the dates, okay, you know, we can look at the price at 75.35. That's the current price. So you can see that these are in the money. Okay, these are in the money. Take a look at the strike price here. Where is the strike price? Right here. Yeah, take a look. 65 bucks. So if I take $65 and I subtract 75.35, you can see that I have a $10 spread that's in the money by 10 bucks. So you're going to pay higher premiums for this. Because it's the one that's in the money the most. Right? It's the one that's got both time value and intrinsic value built into the option. And this one here it's saying right now we've got 35. Okay? Right there. That's 35 cents of intrinsic value in the money. Okay? So if you look at the strike price, 56.28. You say, well, wait a second. Why is that so different? Right? It's not even that much difference. Like, you know, actually, excuse me, that's implied volatility. Let's go to this is 75. My mistake on that. It's a 35-cent difference, right? So if we look at this, you can see the difference is the valuation of the strike price, because this is saying that we're locked in at 65 bucks down here. So this is saying that, you know, the person, if you bought those call options down here at 65 bucks, it's already gone up, pulled back, and it's moving up already. So your stock is moving up. You've already got $10 of intrinsic value. You could execute that position. Let's say you bought this option contract here at 65 bucks. and it's trading at 75. Do you need to hold on to that option contract? No, you could just get out of it. You could close it, exit your position, take the value, take the profit off the intrinsic value and the option valuation, right? So we're going to be talking about how to trade, and we're going to be talking about what to look for. Before we start getting into all the other, we got to talk about options analysis. We need to get into the details on the Greeks. We need to start talking a little bit about options trading, and then understanding how to use the platforms to your advantage. So I just want you to know that if you just look at different platforms, right, you can take a look. I'm sure you could probably add columns to the, and for the sake of this video, I'm not going to spend time going into too much detail on platform training in this video. But as you know, you could easily go up here and, add columns. This has got all the Greeks, and, we're going to add a lot more columns up here. You can see we could customize the columns, right? So I can go in here and customize the columns, and I can add, if I wanted to do in the money, out of the money, looking at those things, because that's what some of the discussions where we were looking at intrinsic value, time value. If I wanted to add intrinsic value right here, there it is, right? If I wanted to look at time value, I don't know if they have time value in here. They don't have it here. Extrinsic value. We've got, I'm not sure if they have in the money, out of the money in here. Maybe they do. Probability of it in the money, there it is the probability of it ending in the money. Right? Probability of it being out of the money, right? Probability of it breaking even, right? These are things that you can add into the option chain to see them. And we'll get into platform training as we progress, right? These are the types of things that I think are quite important if you're going to get familiar on your platforms. Every platform's got a few different features. It's one of the reasons why they build different platforms. Thinkorswim's probably got their own, they got probability analysis here. Risk profiles. And I'm not even going to pretend to start going into all of this because I'm personally not experienced on the Thinkorswim platform at the time of filming this video, but I do have the intentions of getting familiar with it. My go-to platforms have always been TradeStation, TC2000, Questrade, because I've traded them and I've used them, right? So it's just you pick and choose your the platforms that you're familiar with. And my strong suggestion moving forward at this course is that you highly get in tune with the platform that you're using, because you definitely don't want to be making mistakes with options trading by not understanding how to use the platform. Okay, very, very, very important. So the main lesson for today is understanding terminology between the option quote. Very, very useful, very, very important. So that's one of the biggest parts of this lesson. Okay, was the options quote, and then also discussing in the money, out of the money, intrinsic value versus time value, so that you get an understanding of what that means. Okay, traders, so we're going to talk soon. We'll see you in the next video. If you have any questions or you need assistance with these topics, please let us know so that we can help you moving forward. Take care. Welcome back, traders. Now that you have a solid foundations of the options trading industry, what we're going to do is make sure you don't miss out on the other videos below this video. We've got links below, so make sure you click them, because there's definitely valuable content in the rest of the series you don't want to miss. Also, be sure to hit that subscribe button and share this video with a friend. That way they can get the results that you are as well. Also, if you have any questions or need assistance, get social with us. Leave a comment below, ask